Okay, we have a lot to get into in a short amount of time. We're going to break this all down for you. The potential banking crisis that started today, the political uncertainties that are likely to start affecting our markets maybe as soon as tomorrow. We also have our CPI report that is going to be coming out that is going to give us a lot of insight to what the Fed is going to do next week on the first Fed rate cut. Beyond that, we have Tesla stock that outperformed big time today, up 4.5%. Is this momentum going to continue, and what do the technicals suggest? And honestly, I think Tesla is the easiest read through of all, because if you're looking at Tesla on the charts, we closed at $226 per share, roughly, including the slight down move here in after hours. That is above your 50-day moving average at about $224 per share. Tesla looks like it wants to break out in a significant way to the upside, but we'll talk about this a little bit more later on in this video. But first, buckle up, because there's not so many good things that actually happened today. There was a lot of troubling things, including the banking sector, and we did have quite a bit of news here today. Ally Bank warns of consumer default. Ally Bank was the worst hit bank today, down over 16% just today alone. We also had JP Morgan Chase shares that dropped 5% after the bank tempers guidance on interest income and expenses. The current estimate for 2025 of about $90 billion of net interest income is, quote, not very reasonable, because the Federal Reserve is cutting interest rates, and said that analysts are a bit too optimistic. This caused JP Morgan stock to drop the most since June of 2020, which is impressive. You also had Goldman Sachs that says they're going to post a $400 million hit or loss to third quarter results as it unwinds the consumer business. They also say that they are on the bad side of the yen carry trade and leveraged a little too much to Nvidia. Now, banks have been one of the sectors that have been leading markets higher in recent weeks. Regional banks, big banks, small banks, medium-sized banks, all banks have been doing well as the Fed is gearing up to start reducing rates. I mean, banks should benefit when rates fall, because that means more people are going to take out home loans, car loans, and that's the biggest segment of profitability for banks. So it makes sense. But today definitely puts a little bit of a spin on what we've seen recently. Next up, you had oil markets. I talked about this a little bit in the last video earlier today, but oil USO, if you're looking at that, was down 3.64% today. Oil is getting beaten up. This is not good. As George Gammon says on X, oil price plummets with 10-year yields as unemployment begins to spike. Sure sign the economy is booming. Now, for anyone that does not know, oil trades on OPEC news, it trades on geopolitical tensions, but it mainly trades based on global economic strength. If we were to theoretically go through a global recession, oil would do very bad, because oil is perceived to do well when economies do well, when there's more of a demand for oil. Whether that is shipping, ships, they take a lot of gas, a lot of oil, cargo planes and, cargo trucks and Amazon trucks. That's what really uses a lot of the gasoline. Now, yes, people cut back on actual travel and, drive less when times are bad. And these reasons are why oil is a pretty good leading indicator or barometer of economic strength. We've seen this in oil markets back in 2008. Now, I was not investing at this time. I was 9 years old at this time. But I remember we were not driving any extra, than was absolutely necessary, because gas was over $5 a gallon in Michigan. And at that time, $5 was like $15 in today's inflation adjusted terms, or at least it feels like. So it was very expensive. And then you had an economic collapse of sorts in 2008. So usually you see oil spike and then come cratering down before the economy gets really bad. And some could say just the last couple of years we've been in an oil spike, and maybe that collapse now could be preceding economic weakness. We know for a fact oil is not doing well because of some economic instability over in China, some weakness over in China, but is that forecasting weakness in the US as well? But the biggest catalyst for tomorrow and near term for markets is CPI. And I have a take that you're really not going to hear from anyone else, okay? Because everyone's so used to inflation, we want it to go down, and if it goes down a lot, that's good. If it goes up, that's bad. At this point, I'm here to tell you, inflation does not matter unless it goes up a lot or goes down a lot. Let me put it to you like this. The same kind of thing works with inflation as energy. Oil. If oil prices are falling, that's implying less demand. If inflation is falling, that is implying less demand to a certain extent. So inflation coming in low was pretty normal from like 2008 through 2019. We actually had a problem getting to 2% inflation. It was just routinely under 2% inflation, like 1.5, 1.6, 1.7%. The Fed was actually encouraging, inflation to go higher. Well, the economy did fine during that time. But if inflation, let's say, were to start coming in negative or close to negative, if we were not seeing any inflation anymore, that would be a much bigger problem and signal an economy that is really, really weakening. Because the only times you've ever seen deflation on a consistent basis for really any developed economy, especially the US, is during hard times, economically speaking, during recessions. Only 3% of all CPI reports have been negative or in deflation territory. It doesn't happen that often. And of those 3% that have been negative for your CPI reports, all of them have been during recessionary periods or right before we're technically declared in a recession. So we've come close to getting some deflationary inflation reports over the past couple of months. The question is, do we get that tomorrow? Probably not. We do have Nick Timmerhaus' famous chart of bank estimates for CPI. You have the median forecast at 0.21%. So when you look at something like trading economics, it comes out in like a rounded number, right, for the headlines, but it's actually not. It's actually down to the decimal point. So Bank of America has 0.21%, Barclays 0.19%, Citi 0.20%, Deutsche Bank 0.23%, Employee America 0.23%, Goldman Sachs 0.23%, JP Morgan 0.21%, Morgan Stanley 0.20%, Nomura 0.17, Piper Sandler 0.16, TD Securities 0.14, UBS 0.20, underlying inflation 0.25, and Wells Fargo at 0.25. Okay, so the estimates are kind of close right now. Most estimates between 0.23 and 0.21. TD Securities is the lowest at 0.14%, and you have three banks here at 0.23, and then you have Wells Fargo at 0.25. Now 0.25 is going to get rounded up to 0.3 on the headline. But if we actually take a look at what this would be on a 12-month annualized basis, at 0.21%, that would be 2.5% inflation. That's still a little on the high side. But if we come in along the lines of what we did last month at 0.17%, that is exactly 2% on a 12-month annualized basis. If you come in lower than that, you're going to really start to bring down some of those 3 and 6 month annualized rates, because the last couple CPI reports we've gotten were, the one was 0.06%. That's what started the small cap rally. The month after was 0.16%, and last month was 0.17%. If we get another number, say 0.15% or so, you're going to be looking at a 3-6 month annualized rate of somewhere in the neighborhood of, let's see, you're going to be looking at somewhere in the neighborhood of about 1.5% expected inflation 12 months from now, if the 3-month annualized rate were to continue. That's on the low side. Not enough, I think, to panic at this point, but it would be getting to a level where you kind of start to wonder if economic activity is starting to take a hit. Now, why this is important is because Deutsche Bank told us yesterday that essentially the Fed's not decided on 25 or 50 basis points, that it's really going to come down to this CPI report. Now, if the CPI report comes in line with estimates, 0.21% inflation, like that's not showing a super weak economy. What is that again? 2.5% 12-month annualized. Let's see, times 12. Yeah, 2.52% 12-month annualized inflation. That's not a bad place to be in. That suggests the economy is doing okay. Again, the more inflation you have, the better presumably the economy is doing, because people are spending more money. They're continuing to buy things, okay? When you get deflation is when people start pulling back. They're not buying as many things, so companies have to start discounting more to keep selling, right? That's why inflation's, the root of it is an economic barometer, more than really anything else, okay? So if we get an inline CPI report tomorrow, I think that's good news for stocks, really good news for stocks. I think that cements the 25 basis points, and great. If inflation comes in a little bit on the high side, I still think that's fine for stocks. I still think, markets can do well. I think that solidifies 25 basis points. If CPI comes in low, which this is going to throw you guys for a loop. If CPI comes in too low, like less than 0.10%, like if it is another one of those just, wow, that was a really low CPI report, like your 0.06% you had that sparked the small cap rally, I don't think that's going to be good for markets. I think that's going to spark a little bit of fear that the economy is slowing too fast, something along the lines of what you're seeing right now in China that just had, their 3-month, 6-month, 12-month year over year and, month over month CPI numbers come in deflation territory. China's had 5 quarters of deflation. That might spark some fear for our markets, and that would likely solidify a 50 basis point cut from the Fed. And Nick Timmerhouse, here on X, this guy with the Wall Street Journal, he is supposedly going to be the individual that gives us that final, tweet, if you will, from the Fed. Okay, he's really seen as the Fed's mouthpiece that does the communications for the Fed to communicate with the markets. And if we are hit with the prospects of a 50 basis point cut, I don't think that's going to be good news for markets. Now, with that said, Jamie Dimon today did say the worst outcome is stagflation, a scenario he's not taking off the table. And that is another one of those headlines that affected markets today. Now, beyond just your CPI report, the 25, 50 basis point argument for the first Fed cut, some of the weakening that you're seeing in the banking sector today, you also have the election coming up. And these political tensions, if we can call it that, are likely to really ramp up in October. But I wouldn't be surprised if we start to get a little bit of a glimpse of this coming as early as tomorrow, because you have the first presidential debate tonight, and we know both sides have unfavorable economic policies, at least temporarily, for markets. Now, one is obviously better than the other, right? T-Man could be better for markets than Kamala's proposed increase of the corporate tax rate from 21% to 28% could just cleanly take off 5% of EPS for 2025, just based on a higher tax rate. Like, if we start to pay attention to that, if we start to try to price that into markets, then I wouldn't be surprised if that does negatively affect stocks. Because let's run some simple math here, okay? We're expecting $280 of EPS next year. You say give that a 20 times multiple, or let's say 20 and a half times multiple, because that's more so where markets were just trading at. That gives you a end of the year price for the S&P, or SPY for this matter, of 574. Today, the SPY is at 548. It's like 3% upside. A little bit more than that. 3.5, give or take, percent upside. Great. But if we take, I'll actually keep that up just to make easy reference here. Just pull up another calculator. If we take 5% off of 280 for EPS, that's going to take $14 away from potential earnings next year. So that's $266 of earnings next year times 20.5 as your multiple. Then you're looking at an S&P that closes the year roughly where we are now at 545 would be a fair value for the S&P by December. Okay, that's not super exciting from current levels, let alone if the multiple falls because recession fears or whatever else comes about. Then you're looking at the S&P that could or should go lower into year end. So this is really like a $30 difference in the SPY, which is about an 8%, 7.5%, 8% difference in where a fair value in the SPY could be. Just taking off 5% of your EPS estimates for next year. It's not a 1-to-1 ratio because of that multiple. It's actually, you take off 5% of EPS, you could trade lower 7-8% from where we could be otherwise, right? And that's roughly where we are now, but that would mean the S&P would be flat. And that's, again, minus any recession fears, minus anything else getting worse from here. Just things kind of staying how they are. That's not that attractive when you do have recession risks, when you do have other political possible outcomes, right? It's not just the corporate tax rate that could be affected. You also have taxing unrealized gains. And I actually think that could be a net positive for stocks in a weird way, because if you tax unrealized gains, then you also write off unrealized losses. And I think that would prompt a lot more risk taking. Let's say you made a lot of money in a year. Your homes went up in value. You own apartments, you own stocks, whatever it is, and you're taxed on that unrealized gain. Great. What are you going to do? Are you going to pay a bunch of taxes on that? Or are you just going to go out and take more risk and try to make more? And then ultimately, end up just paying a higher tax bill with more risk instead of paying a short-term capital gains tax now. I think it would really disincentivize long-term, buy and holders of stocks, and would really encourage more risk-taking behavior, which in the short term would be positive for markets, in my opinion. Would it be positive long-term? Probably not. Yeah, that would probably set us up for another .com style like bubble. Although I do think the legality of taxing unrealized gains is a little difficult. So point is, you guys can see how the political environment that we are in can have a real impact on the S&P 500, on markets. And I didn't just make that 5% EPS hit up for next year. That was actually research done by Goldman Sachs. Now, Trump, in all fairness, is looking at doing a 10% tariff on everything at the bare minimum. And that would obviously have some kind of negative economic effect as well, although I don't know what that is. I haven't seen any research on this, and I could speculate, but I don't want to speculate with something like that. So let me know down below in the comment section if you have seen any kind of research on what kind of hit that could cause to the S&P 500 as far as earnings estimates for next year. Now, what does this mean for Tesla? As I said in the beginning of this video, Tesla's above its 50-day moving average. Momentum looks strong to the upside. I think Tesla's really just ready to break out further. In the short term, you're kind of forming a cup and handle formation, which you could see that here. You got the cup. It looks like you're forming a little bit of a short-term handle here, which could lead to a little bit more of an explosive breakout, potentially to the 250s, 260s. Wouldn't even surprise me by the end of this week, as long as CPI comes in around expectations tomorrow, and maybe even the initial jobless claims come in low on Thursday, and PPI comes in good on Thursday. It wouldn't surprise me to see this short-term cup and handle formation actually, play out into a larger breakout, if not this week, even next week. But the bottom line is for Tesla's going to do whatever the markets do. So we've seen the markets were really bad on last Friday, and Tesla was down almost 9%. I don't think that aspect's going to change either. If markets have bad days, Tesla's going to have really bad days. If markets have good days, or if Tesla gets good news, Tesla's going to have really good days. And over the past couple of trading sessions, we have gotten a fair bit of good news. On Thursday, we had really good news. Tesla stock went up 5%. Today, we had really good news. Tesla stock was up 4.5%. And I think that is a generalized theme as well, as we do start to get some Fed cuts in the books, and as maybe the soft landing prospects become a little more obvious, then I do think good news for Tesla is going to be really, really good news. So would I be short Tesla at these prices? Obviously not. Is there a trade to go long on Tesla? Obviously, Tesla's above its longer-term downtrending trend line as well. But is it a guarantee that Tesla's going to go higher? Is it a guarantee that markets and Tesla are not going to fall from here? Absolutely not. So I think you want to have some positioning, but I do think you want to be ready to buy the dip if that dip does ultimately come. And I do think at some point between now and the election, you will see a full-blown correction. The S&P, I believe, is only down like 3% now. From all-time highs, I want to say something along those lines. Let's see. I seen the stat earlier. I don't remember. 2.88%, 2.99%. Yeah, roughly 3%. I was pretty accurate with that. I do think in the end, you probably get a full-blown 10% correction, which will likely send Tesla stock back to the 200s, if not potentially even a little bit lower than that. A 10% correction from the highs would put the SPY at about 509. I think that's probably likely at some point over the next 8 to 10 weeks. So let me know what you think about this information down below in the comments section. Tomorrow is going to be massive. I would love your thoughts on that down below. You guys have a great rest of your day, and I will see you in the next one.